Welcome back. Finance Minister Nirmala Sitharaman reviewed public sector banks and regional rural banks on the back of slowing deposit growth. In fact, RBI in its latest State of the Economy bulletin also told the banks to find ways to bridge the gap between credit and deposit growth. According to states and according to the Reserve Bank of India's report, there is an imbalance between the two financial metrics as deposit growth has consistently outpaced loan growth for over a year now, and banks are facing pressure on net margins as a result. According to the latest data, as of July 2024, year-on-year bank credit growth stood at 13.7%, while deposit growth lagged at 10.6%. There are interesting trends emerging as far as bank deposits is concerned. Remarkably, a 47% growth in terms of deposit is now held by senior citizens only, implying that younger cohort is increasingly shying away from traditional avenues like bank deposits. In contrast, the median age for all investors in capital markets is now 32 years, with 40% investors in capital markets being less than 30 years old. Now, bank deposits, despite faring much better than riskier assets on safety and liquidity aspect, fare low on return parameters and are therefore less preferred, at least by younger people. Now, Finance Minister Nirmala Sitharaman has asked public sector banks to enhance deposit mobilization to sustain credit growth. Now, despite robust credit growth, deposit collections has been flagged as needing improvement. So how do banks really up their deposit collection? That is the topic we are discussing today. Joining us is Sujan Hajra. He's Executive Director and Chief Economist at Anand Rathi. Sujan, welcome back. Thank you for taking time out. Do you believe that there is a concern right now as far as deposit and credit deposit and credit with public sector banks is concerned, as well as the regional banks? Because that is what Finance Minister has flagged, and that is exactly what RBI is also suggesting, that as far as percentage is concerned, there is now a divergence between the two financial metrics.
This is not new. Actually, for quite some time, the credit deposit ratio has been pretty stretched. And if you look at in terms of incremental credit deposit ratio, in different phases, it has been over 100%. So yes, there is a significant mismatch between the credit and deposit growth rates. But having said that, what is important to understand that the base for credit and base for deposits are pretty different. So deposits are much bigger in terms of the absolute amount as compared to credit. So in a sense, for a period of time, differential growth rate in both can be breached just because the base for deposit is much larger.
Okay. I'm looking at the SBI report right now, which is actually contradicting, some of these statements. In fact, SBI report is dismissing that and calling it a statistical myth. There are numbers that we can put out for our viewers. Essentially, in terms of absolute numbers, SBI suggesting that there is no bridge between credit and deposit, and when you look at data coming in from financial year 2022 onward, in absolute numbers, they are quite in line with what is expected. I want to talk to you largely about the data that is coming in as far as FDs is concerned, because that has been a cause of concern. Now, Finance Minister, of course, saying you need to do something to public sector banks and regional banks, that you need to do something and do it fast in order to mobilize credit, have enough credit growth. Can the banks at this time, independent of policy intervention, do something to ensure that there is more deposits coming in?
So obviously, what has to be done there is to increase the deposit rates. So if you give higher interest rate, see what is important to understand, that taxation of deposits is very different from taxation of particularly equity assets. Your deposit gets taxed at the marginal rate of taxation, whereas the equity assets get taxed at capital gains, which is 12.5% now for long-term capital gain and 20%. And also, what is important to realize that you pay interest on your you pay tax on your interest accrued, whereas you pay capital gains only when you are buying, only when you are selling. So the point of incidence of the taxation is also different. So these are the factors apart from the difference in return. This can taxation also can be a factor why the deposit growth is lagging in the sense. So banks have to necessarily increase the interest rate to mobilize more deposits.
Okay, but would you suggest that to banks right now to really increase interest rates? They have done so consistently in the past couple of years. We don't have the exact number or data, but every time there's been a rate hike, there's been a consistent hike in FDs and interest rates as well. Or would you right now ask for the government to perhaps relook at how FDs and the return on FDs are really taxed?
So the taxation has always been an issue on deposits, and so far I understand banks have time and again asked for taking interest, a parity between the taxation of deposits and that of other assets. So that is a long-standing demand for banks. But having said that, what is important to realize that the gap between the lending rate, average lending rate, and average fixed deposit rate, there is a huge gap. Earlier, banks justified this gap because they used to talk about the branch banking, and so therefore the operating cost being high. Subsequently, when the argument was that Indian banking system has large NPA and therefore provisioning requirement, that's why you need to maintain a large margin. The NIM for Indian banks, or the spread between the deposit rate and the lending rate, is one of the highest in India in the world. So eventually banks have to narrow it down. So as you started by saying, there will be margin pressure on banks eventually because of this.
Okay, before I let you go, is that an imminent problem to you, Sujan? Because there is conflicting data emerging from SBI and RBI. Right now, is that an imminent problem to you? Something that the banks will have to immediately look at as far as pressure on NIMs is concerned?
So what I don't think it's as I said, this difference is because the base for the deposit and the base for the credit is very different. That's why the difference in the growth rate can be sustained over a longer period of time. I think the problem is much bigger for private sector banks than public sector banks. Where private sector banks, many cases that their incremental credit deposit ratio is above 100, and therefore they have to resort to market borrowing. So I don't think for public sector banks there is such an acute problem right now.
Okay.
So they can resolve this problem eventually rather than on immediate basis.
All right, Sujan Hajra, thank you very much for taking time out. Thank you for joining us on that very important story.